There is a moment that nobody warns you about. Not your financial advisor, not your accountant, not the retirement planning seminar you sat through at the Holiday Inn in 2019. Nobody warns you about the morning a surviving spouse opens a letter from the IRS and realizes that the government just became the largest beneficiary of everything her husband spent 38 years building. Not through bad investments, not through fraud, not through any mistake she made. Just through the calendar flipping to January 1st, with one fewer name on the tax return. That is the moment I want to talk about today, because it is coming for a lot of people watching this. And the difference between losing $60,000, $70,000, $80,000 a year to the IRS after your spouse dies and keeping most of that money in your family comes down to 4 specific assets, 4 moves, and whether you made them before the funeral, not after, before. Let me show you exactly what I mean. Picture a couple, retired, comfortable, did everything the right way, paid off the house, funded the 401k for decades, never carried credit card debt, drove the same cars for 12 years because they were savers, not spenders. Classic American middle-class retirement story. Their combined income in 2025 looks like this. 2 Social Security checks totaling around $60,000 a year. A small pension from a lifetime of work paying $18,000. A traditional IRA worth roughly $740,000, mostly rolled over from a 401k, throwing off a required minimum distribution of about $28,000. A taxable brokerage account generating $6,000 in qualified dividends. And a few CDs at the credit union paying around $4,400 in interest. Added up. $116,000 gross income. Married filing jointly. After the standard deduction, the age 65 add-on, and the senior bonus deduction from recent tax legislation, their taxable income drops to around $77,000. And here is the beautiful part of being married on paper. The 22% bracket for a married couple in 2026 does not kick in until taxable income crosses about $97,000. So this couple sits comfortably inside the 12% zone. Their total federal tax bill is somewhere around $8,400 on $116,000 in gross income, an effective rate of roughly 7%. That is a good outcome. That is what smart retirement planning looks like. Now the husband dies in January of 2026. Everything I am about to tell you is not a worst-case scenario. This is the standard legal operation of the United States tax code, no mistakes. No bad luck, just math. The wife is now a single filer, not because she chose to be. Because the IRS determines filing status based on December 31st of the tax year. And her husband is gone. Her income drops. She loses his Social Security check. The household Social Security falls from $60,000 to about $37,200. The pension had a 50% survivor benefit, so that income cuts in half from $18,000 to $9,000. The IRA still sits near $720,000 by year-end, and her required minimum distribution is still around $27,500. The brokerage still pays $6,000 in dividends. The CDs still generate $4,400. Her gross income for 2026 is $84,100. She is $32,000 poorer than when her husband was alive. Now watch what the tax code does to her. As a single filer, her standard deduction is cut in half, down to about $15,750. She still gets the age 65 add-on and the senior bonus deduction. Her taxable income lands around $60,350. And here is the wall she just walked into. The 22% bracket for a single filer in 2026 begins at $48,475. She is $11,000 past that line. She is paying 22 cents on every dollar above that threshold, but that is only the first blade, because her income level also triggers the Social Security taxation trap. For a single filer, once provisional income crosses $25,000, up to 85% of Social Security becomes taxable. That threshold for a married couple is $32,000. The IRS literally gave couples $7,000 more in breathing room, then yanked it the moment one of them died. Her Social Security, which was partially shielded, is now almost fully exposed. And then there is IRMA, the income-related monthly adjustment amount, the Medicare premium surcharge that most people have never heard of until it shows up on their statement. While her husband was alive, their combined income kept them well under the married couple IRMA threshold of around $212,000. She paid the standard Part B premium. Now she is measured against the single filer threshold, which sits considerably lower. Her income pushes her into the first IRMA bracket. Her Medicare Part B premium climbs from about $185 a month, roughly $260. Her Part D drug plan gets hit with a surcharge on top of that, nearly $900 a year extra, every year. For the rest of her life, layer it all together. Tax bracket collapse, forced RMD income she cannot control, Social Security now almost fully taxable. IRMA surcharge added permanently to Medicare. The woman who paid around $8,400 in federal taxes last year as part of a couple is now looking at a bill closer to $73,000 on less income, same accounts. Same nest egg she and her husband spent 4 decades building together. Her tax bill did not double, it did not triple, it quadrupled, on a smaller income. That is not a glitch. That is the system working exactly as designed. There is a name for this. Professionals who study retirement taxation call it the widow's penalty, and it has 3 distinct mechanical layers that stack on top of each other. Most advisors only talk about the first one. Layer 1 is the bracket collapse. When a couple files jointly, the tax brackets are wide, generous, almost. The 22% bracket stretches across $110,000 of taxable income for married filers. For a single filer, that same bracket covers about $54,000, half the width. The whole architecture of the tax code is built around couples. The moment one of them dies, the survivor falls through a trap door that was always sitting right there underneath them. Layer 2 is the RMD crossfire. People sometimes think, well, I will just spend less. I do not need to pull as much from the IRA. But the required minimum distribution does not care what you need. It does not care that you are grieving. It pulls money out of your traditional IRA on a schedule determined by the IRS based on your age and account balance. At 73, your divisor is around 26. By 80, you are pulling close to 5% of the entire balance every year, whether you want to or not. That forced income lands in a single filer bracket and gets taxed at rates that would have been impossible for a married couple. You cannot avoid the withdrawal. You can only control whether it falls into a wider or narrower bracket, and now it falls into the narrower one. For the rest of her life. Layer 3 is the IRMA spike, and this one has a delayed fuse built into it. IRMA uses a 2-year look-back. Your 2026 income determines your 2028 Medicare premiums. So if you take any action in the year after your spouse dies that spikes your income, even smart tax planning like a Roth conversion, you have just scheduled a Medicare premium increase that will not show up for 2 years. By the time the higher premium hits your bank account, most people have completely forgotten what they did to trigger it. That is not an accident in the tax code. That is engineering. 3 layers. Bracket collapse hits the year of death. RMD crossfire hits every single January for the rest of the survivor's life. IRMA spike hits 24 months after every significant income event. There is no way to undo any of this after the funeral. There is only a window before, and that window is what this entire video is about. 4 specific assets, 4 specific moves, done while both spouses are alive, both names still on the tax return, both of you still sitting in the wide married brackets. This is not complicated retirement theory. This is a checklist. Let me walk you through each one. Asset number 1, the traditional IRA, or the 401k, or the SEP IRA, any pre-tax retirement account. This is the single biggest source of widow's penalty damage in the typical American retirement portfolio. Because every dollar sitting in a traditional account is a dollar of future ordinary income that the IRS has not collected yet. They are patient. They let it grow, and then they apply the single filer rates to a larger pile when the surviving spouse is pulling it out alone. The fix is Roth conversions, planned multi-year strategic Roth conversions while both spouses are alive and filing jointly. Here is why the timing matters so much. While you are married and in the 22% bracket together, your taxable income can reach up to around $97,000 before you hit the 24% line. That is a large conversion runway. You can move $100,000 from traditional to Roth in a single tax year, pay the tax now at 22%, and that money becomes permanently tax-free. No required minimum distributions ever, no tax on growth, no tax on withdrawal, and when one spouse dies, the survivor inherits a Roth IRA that generates 0 taxable income. Think about what that means for the widow's penalty math. If you have $800,000 in a traditional IRA and you do nothing, your surviving spouse will pull roughly $28,000 to $45,000 out of that account every year, all taxed at the single filer rate, plus the Social Security inclusion penalty, plus IRMA exposure. The lifetime tax cost on that account after widowhood could easily reach $200,000 or more. If instead you convert that account to Roth over 5 to 7 years while both spouses are in the wider married brackets, The total tax paid is roughly the same in dollar terms, but now the Roth grows tax-free, the surviving spouse withdraws tax-free, and Roth distributions do not count toward IRMA calculations at all. You take a one-time tax hit in exchange for eliminating a recurring tax liability that would have compounded across decades. That trade is almost always worth it. Run the numbers for your specific situation, but directionally, this is the most powerful pre-death tax move available to a married couple. Asset number 2, the taxable brokerage account. This one is counterintuitive, and a lot of advisors get it completely backwards. The instinct is usually to give appreciated assets away during your lifetime, reduce the estate, minimize taxes now. But for a married couple where one spouse may die first, that instinct can cost the surviving spouse a significant amount of money unnecessarily. Here is the mechanism that most people never learn about. Internal Revenue Code Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the survivor, the cost basis of those assets resets to fair market value on the date of death. Not what you paid for them, what they are worth the day your spouse dies. All of the embedded capital gain between what you paid and what they are worth now disappears. The IRS forgives it entirely. So if a fund was purchased 20 years ago for $100,000 and it is worth $240,000 when the spouse dies, the survivor inherits it with a cost basis of $240,000. She can sell it the next day and owe zero in capital gains. $140,000 of gain gone, with no tax consequence. That is an enormous legal, permanent benefit sitting inside the tax code, waiting for married couples to use it. But here is the catch. It only works if the asset is owned correctly at the time of death. In a community property state, California, Texas, Arizona, Washington, and a handful of others, jointly held community property gets a full 100% step-up when either spouse dies. Both halves of the account reset. That is a complete wipe of embedded gains. In a non-community property state, which covers most of the country, Florida, New York, Ohio, Georgia, only the deceased spouse's 50% of a jointly held account gets the step-up. The survivor's 50% keeps the original cost basis. The fix depends on where you live. In a community property state, confirm your brokerage account is properly titled as community property with rights of survivorship. In a non-community property state, speak with an estate planning attorney about whether a joint revocable trust with specific community property language or another ownership structure makes sense for your situation. Wrong titling on a taxable brokerage account is a silent tax bomb. It does not hurt you today. It explodes after the funeral. Asset number 3, the pension. Most people do not think of a pension as something that needs to be protected. The check shows up every month. It feels reliable. But this is one of the quietest traps in retirement planning. When a pension is set up, the retiring spouse typically chooses between two payment structures: a single life option, which pays a larger monthly amount for as long as the retiree is alive, then stops completely at death, or a joint and survivor option, which pays a smaller monthly amount but continues at some percentage, typically 50%, 75%, or 100% to the surviving spouse for the rest of her life. The single life option is almost always the default unless the retiree actively chooses otherwise. And the monthly difference between the two options can look very attractive when you are 62 and healthy and feel like you have decades ahead of you. So a lot of people take the higher check. And then the retiree dies at 71 and the pension income disappears entirely the same month. If you are still pre-retirement, the move is simple. Elect the highest survivor percentage you can reasonably afford, even if it reduces your monthly income now. The income protection for your spouse is worth more than the marginal difference in the monthly check. If you are already retired and locked into a single life election, you cannot reverse it, but you can compensate for it. A permanent life insurance policy on the pensioner's life, sized to replace the lost pension income stream as a death benefit, accomplishes essentially the same goal. This approach has been around for decades. The pensioner takes the higher single life payment, uses a portion of the differential to fund the insurance policy, and when the pensioner dies, the surviving spouse receives a tax-free death benefit that replaces the lost income. Under Section 101A of the tax code, life insurance death benefits are income tax-free, no bracket exposure, no IRMA trigger, no RMD complications. The pension income stream gets converted into a tax-free survivor benefit through the insurance wrapper. Asset number 4, CDs, money market funds, and taxable bond portfolios. This is the slow leak that most retirement couples do not even notice until it is too late. A typical retirement household has somewhere between $50,000 and $300,000 sitting in high-yield CDs, treasury bonds, or money market accounts. That interest income gets generated every year. It is predictable, it feels safe, and while both spouses are alive, that interest gets absorbed into the wide married filing jointly brackets without causing much damage. It just sits there as part of the overall income picture. Then one spouse dies. The same interest stream gets pushed into the narrower single filer brackets. It may push the survivor across an IRMA tier. It adds to the income base that determines how much Social Security gets taxed. The accumulated effect of $150,000 in CDs generating $6,000 a year in interest can push a grieving widow from one bracket into the next, or from one Medicare premium tier into the one above it. Not because the income is large, but because every dollar counts differently in the single filer tax environment. The fix is to restructure the income those accounts produce before death so it comes out in a more tax-efficient form. 3 options. First option. Replace high-yield CDs with high-quality municipal bonds from your home state. Interest from in-state municipal bonds is exempt from federal income tax. For someone in a high-tax state like California, a municipal bond yielding 4% can be the economic equivalent of a 6 or 7% taxable bond after factoring in what you would have paid to the IRS and the state. It still counts toward the Social Security provisional income calculation, so it is not a perfect solution, but it eliminates the federal income tax line on that interest entirely. Second option, shift the cash into a multi-year guaranteed annuity, sometimes called an MYGA. These products compound tax-deferred inside the wrapper. The interest does not show up on a 1099 every year. The surviving spouse can then take strategic distributions in years when other income is low, rather than being forced to recognize income every single calendar year regardless of need. Third option, fund a properly structured cash value life insurance policy. Growth inside the policy accumulates tax-deferred. Withdrawals up to basis come out tax-free, and any death benefit paid to the surviving spouse is income tax-free under the same Section 101A, discussed with the pension strategy. 3 different tools. The right one depends on your state, your tax bracket, and how soon you might need access to the money. A fee-only fiduciary advisor who specifically understands widows' penalty planning can model all 3 scenarios for your specific numbers. Now look at what changes if you execute all 4 of these moves before the first spouse dies. The traditional IRA has been converted to Roth. The survivor inherits a tax-free account with no required minimum distributions and no IRMA exposure from withdrawals. The taxable brokerage is titled correctly. The survivor gets a full or maximized step-up in basis and owes nothing in capital gains on decades of embedded appreciation. The pension is either on a joint and survivor election or has a life insurance policy behind it. The income stream continues to the survivor in a tax-free or tax-advantaged form. The CDs and bonds have been restructured into municipal bonds, deferred annuities, or insurance products. The recurring interest income no longer piles into the single filer brackets every January. In our example at the beginning of this video, the woman looking at a $73,000 tax bill on reduced income would instead be looking at something closer to $8,000. Same gross income, different account architecture, $65,000 a year recovered. Over a 20-year survival period, that is over $1 million of difference, not from brilliant investing, from account structure and titling decisions made while both spouses were still alive. One final thing before I let you go. The window to do this work is not permanent. It is actually narrower than most people realize. Roth conversions done properly take 5 to 7 years to execute without spiking your own bracket in any given year or triggering current year IRMA penalties. Pension elections are locked the moment you start drawing. You cannot go back and change them. Life insurance underwriting requires both spouses to be in reasonably good health. Once a serious diagnosis arrives, the ability to get coverage at a viable premium often disappears with it. Trust and account retitling requires both spouses to have legal capacity to sign documents. A cognitive decline diagnosis can remove that option quickly. If one of you is already in declining health, a significant portion of what I described today is off the table. The IRS is counting on couples to wait. To assume the default settings of their 401k plan and their joint brokerage account and their single life pension are somehow going to protect the surviving spouse, they will not. The default settings of the American retirement system were not designed for surviving spouse protection. They were designed for maximum government revenue extraction at the most vulnerable moment in a household's financial life. Tonight, sit down with your spouse. Open a notebook. Write down 4 categories: traditional IRA or 401k, taxable brokerage, pension election, CDs and bonds. Next to each one, write what you own and how it is currently titled. That is step 1. Step 2 is finding a fee-only fiduciary advisor or an estate planning attorney who has actually modeled widow's penalty scenarios before. Not someone selling products. Someone who can run the math on your specific numbers and build a multi-year conversion and restructuring plan. The tax code does contain the escape hatches. They sit right next to the traps. You just have to read them while you still have time to use them.